Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Shopify stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Shopify is an e-commerce company. It allows individuals or businesses to easily set up an online store and sell their merchandise. It also offers Shopify POS if you want to sell products in a physical location. Say for example, I made customized jewelry and wanted to sell my products online. I would go to Shopify and pay them a monthly fee so I can simply list my products on their platform. The monthly fee can be as low as $29 or up to $2,000 and possibly more with add-ons. There are plenty of free and premium templates on their site to make my store look nice and marketable. Their website is secure, so you do not have to worry about hackers or the site crashing. The great thing about Shopify is you can pretty much sell anything, whether it's a physical product that needs to be mailed or a digital item that needs to be downloaded. The company is headquartered in Ontario, Canada, and was founded in 2006. The ticker trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, Sao Paulo, Buenos Aires, and London Stock Exchange. Let's get started with the model. This is a large cap company, 45 billion market cap. They're trading at $3.53 a share, and they have 126 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow grew a ton from $8 million to $450 million, but it did drop in the trailing 12 months to $250 million. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was negative in 2019, positive after that. Revenue is a sales for the company, and that looks really good. It triples from 2019 to the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that grew from $900 million to $2.6 billion. Their gross margins are pretty steady year to year. It was 55% in 2019. That's gross profit over revenue. And it dropped a little bit to 53% in the trailing 12 months. You would expect your margins to grow as your revenue grows. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. Gross profit minus operating expenses gives you your operating income. That was negative in 2019. Then it's positive after that. Their operating margins are all over the place. Negative 9% in 2019, 3% in 2020. Then it grew to 6% in 2021. Then fell back down to 1% in the trailing 12 months. You may want to look into their operating expenses a little deeper to figure out why. They received $19 million of interest on their investments and only paid $1.2 million of interest on their debt. So it doesn't look like they have too much debt. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. They had a big gain in 2021, $2.9 billion. Then you have your pre-tax income, your taxes, and the bottom line of the income statement is your net income. And that was negative in 2019, a big positive in 2021 due to this large gain in other income and expenses. Negative in 2019, 11% in 2020, way up to 63% in 2021, and down to 4% in the trailing 12 months. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. They generated most cash flow in 2021, $500 million. Most of their CapEx spend is on their software. Operating cash flow minus CapEx gives you your free cash flow. And they are cash flow positive each year. But they are doing a lot of dilution. They added $688 million of stock in 2019, $2.6 billion in 2020, and $1.5 billion in 2021. Every time a company issues common stock, it increases the shares outstanding and makes your shares less valuable. They also added $900 million of debt in 2020. It looks like they used the equity and debt to acquire other businesses because their investing cash flow is $1.9 billion in 2020, $2.3 billion in 2021. Investing cash flow is where you report the cash you spent on acquiring another business. Let's look at their capital structure. They have $9.8 billion of equity, $1.2 billion of debt. They're 89% equity, 11% debt. And they could pay off all the debt with the cash on their balance sheet and still have $6 billion of cash left over. I gave them a WACC of 8.3%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $40 billion. We discounted those numbers back to today's new weighted average cost of capital. We get a value of the company of $33 billion. We divide that by 126 million shares. And we get a calculated stock price of $258. They're trading at $353, so they're trading at a 37% premium. It's a sell according to the model. I think of all the stocks I valued, this is the one I have the best track record with. Because in December 2020, they were trading at $1,200 and my price target was $722. And after about a year, they hit that price target. They were trading at $626 in February and my price target was $399. And 4 months later, they hit my price target. Now I'm even lower at $258. So maybe in 6 months, they'll hit $258. The company's revenue forecast for 2024 is $10.3 billion. For 2023, it's $7.7 billion. And for 2022, it's $5.8 billion. And I continue this growth into 2025 and I got $13 billion. That's how I got their future revenue estimates. They convert on average 9% of their revenue into free cash flow. So I multiplied these three revenue estimates by 9%. That's how I got their future free cash flows. And the average company in their industry converts 18% of their revenue into free cash flow. So I figure by 2025, they should hit max efficiency and convert 18% of their revenue into free cash flow. Simply Wall Street's valuation is $468. They're saying the stock is 24% undervalued. 27 analysts priced this stock and the average price target is $613. The lowest $400, the highest $1,500. This is where the stock has been trading the last 5 years. Right before COVID, it hit $500 and then it came down a little bit. Not too much, but a little bit. And then the stock just took off like a rocket ship, hitting about $1,900. But the stock price crashed even faster. Over the next few months, it lost most of its value. They have a pretty high beta, 1.8, so the stock is a bit volatile. It moves a little less than 2 times the market. It's gone down 71% in the past 52 weeks, while the S&P is down 3%. The 52-week low is 308, the high is 1760. And the stock is trading below its 50-day and 200-day moving average. 4 million shares are traded each day on this stock. 70% of the shares are held by institutions and over 8% of the shares are shorted. If you put $10,000 into this company when they started trading, you would have been at over $600,000 at one point, but if you're still holding on, you'd be at $137,000. That's a 1,300% return, a 45% annual return. The CEO's salary is $1 million and their total compensation package is $20 million. And it looks like their annual salary has declined over the years, but their total compensation has grown a ton. 36,000 insider shares have been purchased the past 3 months. But the 3 quarters before that, there's been only insider selling, no buying. 65% of the companies held by institutions, 29% by the general public, and 6% by insiders. Their employee count has been going up a ton over the years. They're currently at 10,000 people. The founder and CEO is the biggest shareholder at 6.25%. Then Capital Research, Morgan Stanley, Bailey Gifford, and a bunch of other companies. Let's look at their financial ratios. They have a really bad PE of 246, that's stock price over earnings per share. Price to sales of 9.3, that's stock price over sales per share. Price to book of 4.6, and a really bad price to free cash flow of 176. They have a low return on invested capital of 1%. They can easily cover their interest payments with their operating income. A low ROE of 2%. They have a ton of current assets on their balance sheet. Their current ratio is 11.8. Same thing with the quick ratio. They generated $250 million of free cash flow in the trailing 12 months, and they have $7.4 billion of working capital. So it looks like the company is pretty well funded. The best way to look at ratios is to compare them to companies in the same industry. There are 252 companies in the same industry as Shopify. And if Shopify has number in red, they're worse than the average. If they have a number in blue, they're better than the average. They spend a little more than average in CapEx. They have a good debt to equity ratio. They rank 8th in market cap. The average is 6.2 billion. They're 45 billion. They have a good price to book, but their PE, price to free cash flow, and price to sales are worse than average. They generate more revenue than the average company, and their 5-year annual revenue growth rate is 61%, which is much higher than average. So to summarize, I have them trading at a 37% premium, and this is one of the worst performing stocks the past 12 months. But I think they have a great business model, and they're growing. Their revenue is growing a lot. So this might be the bottom. This could be the right time to get in. But it's like trying to catch a falling knife. I know lots of people watching this video have probably lost money on this stock, but this time may be different. I ranked their free cash flow 7 out of 10, their revenue 8 out of 10, and their ratio is 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation, you can become a member by clicking on the link in the description below. Thanks for watching.